Yeah, so good evening, everyone. Sorry, in the morning we had power blackout at around 2 a.m. So, and actually for those of you who stays where I stay, near where I stay, you can confirm there was power blackout. So we had, as our initial plan, we had to meet. Liwe liwalo, lazima tutasonga. So I want to take you through a topic. We are done with the segment. So this is like our third topic, IFRS 9. So this is a new topic. IFRS 9. So IFRS 9 is on financial instruments. So financial instruments will check financial assets and liabilities. Financial assets and financial liabilities. So what you're going to do, because there are some notes which you are supposed to write, and if I give you time to write them, we'll just be wasting time. So what I'm going to do, allow me to share those notes. We go through them together. You can leave the space because it's like 2 pages. You leave the space. At your free time, you can write them down, because writing those notes right now will waste our time. But make sure umeziandika. So allow me to share with you these notes. Just a minute, then we check together. You leave space, you'll write later, so that we can do the relevant questions. So give me a minute to share. So I'll share the notes with you. Kindly check. So open that handout. I believe everyone has gotten the handout. So before we start going through the notes, allow me to give you overview of financial instruments. So when we talk of financial instruments, if you can put that wording other way around, they are instruments of finance, if you may put it in that casual way. When we talk of financial instruments, we are talking of things like bonds, bills, loan notes, among others. So what happens, you know very well, when the government wants to borrow, they normally give out the bonds. Giving out the bonds is what you call flotation. So they float out these bonds to the public, both local and maybe even foreign. Then once they float these bonds, they receive, because bond is a way of borrowing. So they receive funds from the public. Then after receiving the funds, they issue the public or whoever has taken the bond with the bond certificates. So the terms are well outlined. Let's say it is 10 years bond. So you as the public, you will give money to the government. If government are the ones floating the bond, you will give out the money. You stay with the certificate for that specified period if it is 10 years. However, during that 10-year period, they will be required to be paying you interest over that period. So it is a form of investment. So our main question is, how do you recognize such transactions in the financial statement? That is going to be our main concern. So with that overview, let's go through the notes kindly. Let's go through the notes. We read as we discuss where necessary. So financial instruments are contracts which entitles an entity or a party to receive cash or equity instruments of another entity. Examples of financial instruments include debentures, loan notes, bonds, among others which I've mentioned. Those are examples of financial instruments. Before I go far, there is something you need to know. Financial instruments, they give rise to both assets and liability at the same time. It is a liability to the issuer. So if the government is the one issuing the bond, it becomes a liability on their side. While you, who is receiving the certificate in exchange for money, you have invested, so it is an asset on your side. So this we should mention from the word go, because when now we'll go to the questions, accounting will depend. You are accounting in whose books? In the books of the borrower or in the books of the investor? So investor is the one giving out the cash, while the borrower is the one giving out the equity instrument. These bonds, we call them equity instruments because they have the equity element in them. So it's a liability to the borrower and an asset to the issuer. So it depends on whose books you are dealing with. Classification of financial instruments. So this was a question which was asked in May 2019, question 4A. May 2019, question 4A. So we used to classify them, and when kuna watu wanasema tunasoma vitabu kubwa, sawa, but some books are not yet updated with this standard is new. I'm not very sure, but I think it came to force in 2019, 2020. It is not an old standard. So there before, we were applying a standard known as IS number 39 on accounting for this, where they were being classified into 4 categories. But now IFRS 9 classifies them into 2 main categories. Number 1 being financial assets at fair value through profit or loss. Those are short term. You know, you can have these financial instruments which are meant for short-term trading. Like if I can ask you, most people will tell me about the treasury bills. So those which are intended for short-term trading, we classify them. You know, we normally have the balance sheet and profit and loss account. P&L is normally prepared for the year. Balance sheet is prepared as at, and it recognizes even assets which are moving in the long-term period. So for the short term, we take them to the profits. We take them to the profit account. No matter whatever we're going to read there, fine. But what I want you to master immediately, that financial instruments, they are those which are classified in profit and loss. Those are short-term financial instruments. So we read our short-term financial instruments recognized at fair value. Remember, fair value is always the market value. Gain or loss on their fair value are recognized in P&L. So in the stock market, you are all aware we have the, remind me, because that is more finance. In stock market, you normally say you have the bears and we do have the bears. Wacha ni refrain from finance, nione kama watu pia wanakumbuka FM. In the stock market, mnasemanga we have the bears and the what? Yes, thank you, Karen. We have the bears and we have the bulls. So we have the bears and we have the bulls. That is true. So bears is normally when the market price goes down. They become affordable. Bulls, when we talk of the bulls in the stock market, we are talking when now the prices, when the prices are up. So that fluctuation, we call it fluctuation, the bears and the bulls in the stock market, without or with stability, that fluctuation leads to gain or loss in the market value. So the market value here is what we are calling the fair value. So should this short-term financial instrument gain or loses values due to the bears and the bulls, such gain or loss is classified in the P&L. When I talk of profit and loss account, it is that income statement before taxation. Any item recognized in the income statement before tax is said to have been classified in profit and loss. Whatever comes after that is said to be classified in other comprehensive. Whatever comes in P&L after taxation is called other comprehensive. Kindly note that down. So for short term, if they gain value, they lose value, the gain or loss goes to the profit and loss, which comes before taxation. Actually, maybe it is necessary, yes, it might be for your own understanding because I'm dealing with accountants. Income statement is normally divided into three. We have the trading account itself, we have the profit and loss account, and we have other comprehensive. You need to know how to separate those three. Trading account is the one which starts from the turnover, sales, revenue, up to the gross profits. So anything from top up to gross profit, that is trading account. Then from gross profit up to net profit after tax, that is P&L. Then anything which comes after after taxation, any item which comes after taxation, and I will tell you which items comes after tax, that is called other comprehensive income. I'll be calling it so many times because we'll be meeting it so many times in our course. We call it OCI, other comprehensive income. So gain or loss in value of financial instruments which are short-term, we take them to P&L. So you capture them anywhere before taxation. You don't subject them to taxation there. We proceed with notes. Financial assets, that is classification number 2. Financial assets at fair value through other comprehensive income. These are long-term financial instruments recognized in other comprehensive income. Initial measurement is at fair value and subsequent measurement is at amortized costs. Yes. So you see something like land. Yeah, that would give me a good example. You see like land, when land gains value, when land gains value, that gain is called revaluation gain or loss, depending. That revaluation gain or loss is not recognized in profit account. You cannot value your land, then you subject that to P&L. You know, when you bring it to P&L, anything in P&L will be subjected to taxation down there. So things like when you tell people you will tax them when they revalue land, nobody will ever revalue their properties. Revalue. Or if they revalue, they will be declaring losses with the main motive of tax and a declaration. So what happens when there is gain or loss on revaluation? You take it to other comprehensive income. Other comprehensive are those income which are not normal business trading income. That is what you need to know. So, for example, land, that is not a trading income, and therefore you don't bring it as part of the normal income subject to taxation. You take it down there as other comprehensive. Similarly, this financial, mostly bonds are the ones which falls here. Bonds are long-term, so they are long-term assets. When long-term assets gains value, that gain in value of long-term assets is not subjected to taxation, and therefore we count it as other comprehensive income down there. I hope that is quite clear to us. Recognition of financial instruments. So how do we recognize them in the books? Now that's a frequent question actually. An entity should recognize a financial instrument when it becomes a party to the contractual provision related to the instrument. So this question is normally framed this way by the examiner. Explain when, and I like the word when, that is the main thing, when an entity should recognize financial instruments in the financial statements. So they should recognize immediately they become a party to such contract. As simple as that. So once you are a party, umeenda hapo CBK, umepewa hizo sijui nini, what you have signed, that is the time you need to recognize them in the financial statement. But now, the question will be, what are you going to recognize? What are you going to bring in the financial statement? So what the amount we're supposed to capture is now our next issue, which is the initial measurement. So there is difference between recognition and measurement. Measurement is the amount we're supposed to capture in the financial statement. Recognition is just when should you reflect that in the books. So initial measurement, initially is after you have become a party, all financial instruments are measured and recognized at their fair value, period. So whether, that one means, whether they are short-term or long-term, all of them, you measure them at fair value. What is this fair value? Fair value is the market price of those instruments at the stock exchange on the day you became a party to that contract. So the day umeenda umechukua, stock market ilikuwa inasema, this is the price. So all of them, regardless whether it is going to be short or long-term financial instruments, all of them, you must initially recognize them at fair value. Correct? Subsequent measurement. So subsequent means in the future. How will you recognize in the books? Those classified through profit and loss should be measured at fair value, while those classified through other comprehensive income should be measured at amortized cost. So hapo ndio zinachana. The short term, initially fair value. Long term, subsequently fair value. So the short term ones, you just keep, anytime you want to recognize them in the books, you just check the market. What is the market dictating? This is the price. So short-term financial instrument, you recognize them at fair value on initial recognition and even in the subsequent periods. But the ones which are long-term, the ones which are normally measured through other comprehensive, initially fair value. Actually, initially all of them, you take them at fair value. But in the subsequent periods, you take them at what we call amortized costs. So that brings a question, what is amortized cost? We read, amortized cost is the reduced value of the instrument having taken into consideration the finance cost and the amount paid, that is interest. You know, as time goes by, you know, these are long term, they're even going, some goes even for 20, 30 years. So as time goes by, there is that interest wanakulipa kwa account. You are being paid the interest. And also, there is what we call finance cost. Finance cost is just the cost of financing that instrument, having taken into consideration the inflation adjustment, the foreign exchange fluctuations, all those items. So unaona CBK wasema they have adjusted the lending rate and all that because they take all those factors into consideration. So you having taken all those factors into account, you adjust, actually you increase the bond or for any financial instrument is normally adjusted upwards with the market adjustments. Market adjustments are the inflation, the way I've mentioned, the inflation, risk. Maybe this person has there is risk, some risk even on the credit rating and all that. Also having taken into account foreign exchange fluctuations, then you subtract the actual interest which has been paid. So when you take the principal amount of the instrument, you add the market capitalization, then you subtract the actual interest. What you are getting at the end is called amortized costs. And that is how we measure the long-term instruments. So initially, all of them, whether short-term or long-term, all of them, you measure them at fair value, which is the market price. Then in the subsequent period, in the years to come, the short-term will continue to be measured at the market value. But the ones which are long-term will be measured at amortized cost. And amortized cost, we have said, is the reduced value, or not reduced per se, but the adjusted value of the instrument after taking into consideration the market capitalization. Market capitalization here is the finance cost. Then you subtract the actual interest. The resultant figure is what we call amortized costs. The recognition of financial instruments, the last item in page 1, the recognition of financial instruments. So at that stage, I know examiner will be asking you, under what circumstances should an entity recognize a financial instruments in the financial statement? So one, what is the recognition? This is the removal of a previously recognized financial instrument from the financial statement. You eliminate it off the books. So under what circumstances will you eliminate? So circumstance number one, upon expiry of the contract period. I don't know what happened with the net, but I hope we are okay. So upon expiry of the contract period, so if the bond was going for 5 years and the 5th year has elapsed, you remove it off the books. When the instrument has legally been transferred to a third party, yes, Aisha, you can transfer the contract to an instrument, maybe to George, or you can even transfer it to someone else. When the entity has been prohibited from selling or pledging the initial asset, that one is always open. When you've been prohibited, mostly, maybe the contract has come to an end or something has happened adversely. And when the entity has no further obligation to make payments in relation to the concerned instrument. So if there is no obligation at all, there is no need of you continuing having that instrument in the books. So know those 4 circumstances for the recognition. I know you can be asked anytime by the examiner. I will go through the 4 again on your own, you check. So wewe shika yenye umeshika haraka. Perez umeshika which one? Which one umeshika haraka? Ile hata ukiulizwa usiku, you just wake up. Walter, which one have you just mastered without problems? So those four, you just tell me number 1, number 2, or number 3, or number 4. I want to see which one is easier for people. And others, Gani may, because I know that is a frequent question on IFRS 9. When do we recognize them from the financial statements? Where is ameshika hiyo ya expiry? Expiry is number 1. Shika hiyo kabisa. Ukuja kwa mtihani, at least you have a point there. So we have expiry, transfer, no further obligations, the instrument, and when you are prohibited. Let's go to what are your expiry, your is our reclassification of financial instrument down there. This arises when an entity reclassifies an instrument that had initially been classified as either short-term or long-term in nature. This can only take place when the entity changes its business model of holding financial instruments. Reclassification, it was short-term. Now you have changed. You want it to go for long-term. So the examiner cannot ask you to explain what is reclassification. That one nobody will ask you. But what you can be asked are 2 questions. One, under what circumstances can lead to an entity reclassifying their financial instrument? So they only reclassify if they have changed their business model of holding this financial instrument. Or the other question you can be asked, you explain to the users of financial statement what should happen when there is reclassification. So there is reclassification, you just tell them the ones which were short-term and were being measured at fair value should be recognized and now should be measured at amortized cost, and vice versa. Come on, a long term, it was at amortized cost, now it will be measured at fair value. Just to connect between those lines. Main concerns. So our main concern here, we are heading to computation. Determination of equity component in a bond. And 2, determination of the value of the bond in case it's to be held at amortized cost long term. Those 2. Number 1, on equity. Unajua, wacha niwaambie tu ukweli. Though me si mtu wa finance sana. But what happens, there is no way you can invest in these bonds, then you gain. Yes, we invest. Tuna invest. However, ukiangalia nitty-gritties, you don't stand to gain anything. Those people will always gain. Even you can see Safaricom giving out debentures. They will not give out debentures because they are in financial crisis. Because you know one of the reasons which will lead to a company giving out debentures is to raise funds, because it's a form of borrowing. But some entities will give out those financial instruments as a way of raising more capital, equity, which is obvious. Let me take it to an obvious platform. You give me I borrow from you 1 million right now, or let's say 2 million. I borrow from you 2 million, then I buy 2 plots of land in Kitengela, for example. I buy 2 plots, each at 1 million. Then we agree that I'll refund you your principal amount after 7 years. So your principal amount of 2 million. At the lapse of year 7, sina pesa. So the only option I have is to sell these properties. I sell these properties, then I give you back your money. So after 7 years, in Kitengela, if I bought this at 1 million, you will find this land is even going for 5 million. This one is going for maybe 5 million. I will comfortably sell them at 10 million, then I give you back the 2 million, then I remain with the rest. So whatever I'm saving, having taken the value of money into consideration, is a capital saving, which is equity. So whenever, nilisikia mtu akisema, you know, these legal experts are very funny. There's someone who deliberately failed to pay Kenya Revenue Authority. Yeah, hataki kulipa tax, alipi. And consistently, consistently, this person had not paid from 2012, we are in 2024. I don't know how many years are those. Those are like 12 years. Yeah, alipi. So, but you know, finally, you know, that's a crime, and there is no perfect crime in the world. So finally, alipatikana na taxman. Now he had no problem. What he was doing, which I will not encourage, I can compute this year, this is the actual tax of VAT pay and the rest of it I'm supposed to pay. And my calculator, father is supposed to pay 300,000, and I work here 300 in savings. So yeah, and I save. Then and I know properties. So when taxman comes after 12 years and I dispose property at 100, even 1000% profit, out of ukichukua the accrued interest, then carry immediately, we are giving you waiver on interest and penalties. You know what they are doing. If you pay, we are giving you waiver on interest and penalties. So you pay that, and even it remains with sufficient amount again. But now you see that is not a good operation. But I hope you've understood what I'm trying to say. So these people, what they do, ukiona Safaricom are giving out debentures. Kuna mtu hapa kuna jina ya Safaricom. Safaricom, don't. This is just for illustration. When they give us those debentures, they'll give you the certificate. You give them your 5 million. They stay with the 5 million for 4 years. By the time they are returning the 5 million, if you check the value of money, the purchasing power, you will always lose. Even if you take the interest they are paying you, you will always stand to lose. So whatever you are losing, Silas, that's not a good deal. Whatever you are losing as investor is a gain to them, and that is equity. So one way of raising equity is through borrowing. Then you delay the payment. So in terms of time value for money, the borrower will always stand to gain. That gain to the borrower is the equity. So a student dealing with this topic should know how to calculate, but don't take it to real life. If you take it to real life, you will never invest because utakuwa unafanya hiyo kitu unakasirika. Then also we check how do you determine the bond value. Bond value only when it is long term, where now you amortize the capitalization, the interest, and all that. So let's go down there. We start with equity. Equity components, stock options to equity. We call them options to equity because they are convertible into equity. So equity components, for those who are joining class now, we are in page 2 of the handout in the group. We are in page 2 of the handout in the group. I've seen someone joining right now. I don't know who that is. So it is the difference between the total proceeds, the borrowed funds, and the liability component, amount payable to the investor. Equity component is to be recognized separately as part of equity in the statement of financial position. But it comes as a working, in which topic is this? I think group accounts. If they have given out those instruments, you should be able to calculate the equity and you take it as a reserve under equity down there in the balance sheet. So how do you calculate the equity components? Equity component is equal to the total proceeds. So proceeds is the amount which was given. So come on here, 5 million, the amount you gave them minus the liability component. So the liability component, how do you calculate the liability? Liability component. We are talking on the side of the borrower. So the liability, you as the borrower, you have two obligations to honor. One, to repay the principal amount upon maturity. But now you see the principal, you will pay it in future. So you have to discount. So you will say present value of the principal. This one you will pay upon maturity. But now you have to discount to present value. Then you also have obligation to pay the interest. The interest is mostly on annual basis. So you will also come and say present value of the annual interest. So when you take the total proceeds, which is not discounted, minus the liability, whatever they are going to pay, the difference is equity component. So there is illustration down there. If there's somebody going for prayers, please, you just let me know. So go to illustration down there. Please, I would want you to write that illustration. It's the last item there down there. That one you can write. Having skipped those 2 pages, kindly write for me that illustration. The ABC Limited, yandike your illustration. I want us to compute it. Yeah, I want us to compute it. I believe we are done. I believe we are done. So for the liability, the one they are very rampant on is the next one, the determination of the value of bonds. But this one here, useme ati basi hiyo basi they don't focus, they may not give attention. That one they like giving it in form of additional information. The one we want to do is good to be very specific. They have not brought it just like a standalone question, but as additional information in different topics. You know, this one, even banks, when we'll be doing accounting for banking, because banks also with the instruments, they are rampant there. So just master how to go about it because it will affect other topics. But the second one is highly examined. So allow me to read that question. It says, ABC Limited issued a shillings 2 million 6% bond on 1st January 2015. The effective market interest rate for similar bonds was 10%. The bond is due to mature on 31st December 2019. Okay. Require, calculate the equity component to be recognized in the books of ABC Limited on 31st December 2015. Now, there's something I need to clarify at that stage. We have two rates. There is the 6% and there is the 10%. Right now, banks on mega rate in commercial banks, there's someone, the commercial banks, what is the interest rate right now? They are nowadays changing, I don't know which. What is the lending rate, interest? The commercial banks around, the KCB, Equity, and among others. What is the lending rate on average? Somebody? What is the current market lending rates? Should we talk of 14? What could be the average market lending rates for commercial banks? You also guess 14, around 14%. So let's say 14% for the commercial banks. But for the CBK, I want you to check for me on your Google platform. I will check the CBK lending rates you give me there. It will help me to explain this and it's very important moving forward. What is the CBK's, the current, you can just Google current CBK's lending rates or base, you can call it base lending rate, whichever you want. CBK lending rate. So commercial banks, let's cap it at this one here, commercial banks. What about current is saying CBK is around 13% down. So let's say CBK, the CBK's today's lending rate 13, Yvonne is saying 14.63. So let's just assume it will help me to, because your questions will not be with the exact rates, just guesswork. So it will be okay. So the CBK's lending rate, this is the finance cost, which in this question is the interest of similar bonds in the market. So this is the market rates. So the market rate, when you are dealing around with the instruments, is the one you use for calculating the finance cost. And finance cost, I've told you, it brings into account so many things. They assess the risk. So they do the risk adjustments. We check the inflation. So they carry out inflation adjustments. Then they check the foreign exchange fluctuation. So they bring now the base lending rates. So this is the market rate. So in a question for instruments, when you are given, and in most questions there will be two rates. The effective market rate is the CBK's rate, which is used to determine the finance costs. While the rate at which you will be given, you say, nikienda equity, wananiambia wata tukupatie na 14. When you can pay a loan, we can agree that you give me 0. Those are called 0 coupon, or we agree at 10%. So that is your own agreement. That is called contractual rates. So for instruments, you will have two rates, the contractual rate and the finance cost, those two. So finance cost, which is the effective market rate, you use it to adjust. You adjust the value of the instrument every year because kwani itabaki aje constant na maisha inaendelea. You have to keep on increasing the value. So you add the value of the bond using the effective market rate, then you reduce it with the actual interest. So when you want to calculate the actual interest, you use the contractual rates, the rate which is attached to that instrument. So you decrease it with the actual rate, then you increase with the market rate. That increase in market rate will help you at least to curb inflation. Pesa yako isiumie sana. So you are required to calculate the equity component. So equity component will be the capital saving. The capital saving to the borrower. Mwenye amekopa. You see, they are issuing. So when you issue a bond, you are borrowing because you are giving the certificate in return for money. So at the end, those people normally tend to gain. So whatever they are gaining is what we call equity. So let's go to solution. So solution, we say equity component is equals to the total proceeds, total bond proceeds. You subtract the liability. So you subtract the liability component. Correct. Have that. So because of my board size, nasonga pole pole. So I'll come here and say total bond proceeds, total bond proceeds. So tukikopa, we borrowed how much? 2 million, if I'm not wrong. Yes, this was 2 million, correct. So we borrowed, so here in shillings, we borrowed 2 million. By the time we are refunding this money, so you less the liability component, less the liability component, we less the liability component. So liability component, you start with the present value of the principal. So the present value of the principal will be 1 plus r raised to power negative n, because principal will be paid as a lump sum at the end of the period. So you go for 1 plus r raised to power negative n, which will be 2 million times 1. So discounting, discounting, you use the market rate, not contractual. Market rate is the one you use for discounting purposes. So you will have the 10%, was 10%. raised to power negative. How many years? When was it issued? How many years are those? Let me check if we are together. How many years are those? Those will be how many years? 5 years. Well, those are 5 years. So raised to power negative 5 years. So can you discount for me this one first before we go to interest? Don't bring it to the far end, bring it somewhere here. So can you discount that? Thank you. So what is getting 1241? So this is 1241. 843. Correct. So the interpretation means, you see, the value of 2 million in 5 years to come will be equivalent to 1.2. 1.2, that is because money depreciates, you are aware. So the value will be like, so I could refund the 2 million. So you know when you want to play hard with a discount. This one you can do on your own, by the way. According to Google principle, you know, because you're the one giving. This one is the one you have given me there. Here, your central bank, unaniambia swing 13 number which 14 point something. So you just check. But I will lose 800,000. But now when you bring that complaint, we are giving you interest. We shall be giving you interest at 6% every year. So let's bring up the interest. So present value of the annual interest. Interest, remember 1 plus R. Sorry, it can't be like that. 1 minus 1 plus R raised to power negative n divided by R. Like that. So interest itself is 6%. Aisha, let's click there, then we go for prayers. So 6% times 2 million. 6% times 2 million, that is 200, that is 120. If I'm not wrong, 120 per year. 120 per year. So it means it will be 120 times 1 minus 1.1 negative 5 divided by 0.1. Help me with that figure. Then we shall go for prayers. We come back for something else. How much is that discounted? Now I was getting 454, 454, 894. So what is the interpretation? You know, this is 120 times 5 years. For 5 years, ukifanya kawaida, tutasema ni 120 times 5, which is 600. So the value of 600 will be equivalent to 454. So the total, unajua wewe utakuwa unasherehekea watanirudishia 2 million plus I've earned an interest of 600. But to them, they are not checking it that way. They are checking that we borrowed this, but due to the time value for money, though we are refunding 2, the value of 2 is this. The value of 600 is this much. So in total, they will have incurred a liability of this plus this. How much is the sum of the two? This plus this. The sum of the two. The sum of the two. $16.96. $16.96, $7.37. So the value of all that 2.6 will be equivalent to 1.6. You will be celebrating, they will also be celebrating. Either way. So whatever they are saving is the liability. Where here watakwambia is the equity. So equity component. Equity component is the difference between what they borrowed minus what they are paying. How much is that? Then we go for fares. How much is that? That should be 4.3. You have to take up 4.3 something. 303, 303, 263. That is the capital saving on their side, period. So let's go for fares. That is 703. Let's meet back at 710. Thank you. After prayers, we are back after prayers. And I want us to proceed with the now determination of bond values during the maturity period. So for equity determination, you just have that one. We'll be meeting it in several locations in different topics. So no major issue there. So right there, a subtopic, determination of bond value determination of bond value during the maturity period. During the maturity period. During the maturity period. During the maturity period. So you write and say, this is determined by amortizing. This is determined by amortizing the bond. This is determined by amortizing the bond. By amortizing the bond, having taken into consideration the finance costs, having taken into consideration the finance costs and the interest paid. Finance cost and the interest paid to the investor. Finance cost and interest paid to the investor. Full stop. Full stop. I repeat, this is determined by amortizing the bond, having taken into consideration the finance cost and interest paid to the investor. Who has gotten that question? I was muted. Kuna mtu ameniambia. Page 98. Check page 98. Page 98. Somewhere there. Question 4A. I'm already there. So allow me to read with you the question. It says, I hope you have gotten. E Limited issued a bond for shillings 200 million on 1st January 2018. Interest on the bond is payable in arrears. In arrears means at the end of the year on 31st December each year at an interest rate of 12% per annum. The bond will be held to maturity and redeemed on 31st December 2020 for shillings 258.24 million. The effective rate of interest is 20% per annum. The bond has not been designated as at fair value through profit or loss. It has not been designated through profit or loss. So if it is not designated through profit or loss, it means it is designated at, maliza hiyo sentence nione kama tuko pamoja. They are saying it is not designated through profit or loss. So it means it is designated at what? If they say it is not designated through profit or loss, so that one means it is designated through what? Someone? Correct, Karen? It is designated through other comprehensive income. And the moment it is designated other comprehensive income, it means it is long-term. Long-term means amortization. You need to amortize. When it is going for long-term, it is subject to amortization. Required charge to the income statement for each of the 2 years ended 31st December 2018 and December 2019 formats. Then extract from the statement of financial position as at 31st December 2018 and 31st December 2019. So before we answer Roman 1 and 2, we need to come up with what we call bond amortization schedule. So let's have that. So let's have bond amortization. So bond amortization schedule. So you can have there year, balance brought down, shillings are in millions. Then you will be charged finance cost. So finance cost is the effective interest rate, which the effective interest rate here is 20%. So you bring here 20% finance cost. Then the actual interest paid, I'll see 12%. Then you will have the balance carried down. Mohammed has just joined. How many blank pages should I leave? Can someone answer Mohammed there, please, kindly? Balance carried down, yeah. So Mohammed, meanwhile, we are on May 2018, question 4A, page 98. In number of pages, can someone come in to say that? So balance carried down, also millions. Leave 3 pages. So kindly have that. Good. So the year the bond was given on 1st January 2018. So you just write here 2018. Just write there 2018. So 2018 balance brought down is the principal value of the bond, which was 200. So finance cost is 20% of 200. I hope that is 24. So you will increase the principal with the cost of financing, then you subtract the actual 12% of 20% of 200 should be 40, if I'm not wrong. That is 40, sure. Then 12% of 200 is the one which will be 24. So this one is always paid. So you capitalize. Capitalization means you increase. So you increase the value of the bond with the cost of financing, then you reduce it with the actual interest. So interest is always part of the finance cost. So ikilipwa, you have to reduce this. So the balance carried down, which is the amortized cost, is this plus this minus the interest. How much is that? That one comes to how much? $216 million. 216. So 2019, which is the last year, is 216. You take 20%. So 20% of 216 should be 43 point something. 43 points. Let me see from someone. 43.2. Then interest remains constant. Interest, you don't compute on this one here. Interest is based on the opening figure throughout. It remains constant throughout. The actual interest, this one remains constant. It doesn't change. What changes is finance cost because of the market. So finance cost will change because it is based on the amortized cost, but interest is based on the nominal. Actually, that's the correct one. Interest is based on the nominal value, while finance cost is based on the amortized costs. Perfect. So take this plus this minus 24. What do you get? Thank you. So that is 235. Wait. Just read the last bit. The bond will be held to maturity and redeemed. There is a paragraph there where they are saying the bond will be held to maturity and redeemed on 31st December for 258.24. So check here, please. I was not to have this bracket. This is the year when it will be redeemed. So on the redemption, it will be, you will be paid your interest plus the redeemable amount. So mostly we normally redeem the principal, which is 200. Not be sure you when you before, but you can negotiate to redeem at a premium. So like here they were redeeming at a premium, which is 258 point what? 0.24. Of which, if we are accurate, it should come to zero. Avoid back in a balance. Some are small negative. Any negative means the amount has already been paid. So in 2019, we are going for how many years? Oh, we are going for 3 years. So. This is second year. So then what it was correct, 235.2. Then the last year is when they will redeem. Thank you, 2020, which is 235.2. 20% of this figure will be how much? 47.04. 47.04. This now will be 24 plus what I'm saying, 258.24. 258.24. So it should be zero. At the end, once they redeem, there should be no balance, or you can have a negative. Always, if you get negative, it means the amount is fully compensated. You just write nil. But tell me the actual you're getting this plus this minus the entire bracket, the interest for that year, and also the redeemable amount. What do you get? You get zero. So that is nil. But now you see that was not the question. That was not the question. The question was charge to the income statement. So charge is just an extract for the year 2018 and 2019. So right there, charge to profit stock loss. Charge to profit stock loss 2018, 2019. This is where now we are answering the question. So shillings are in millions. Shillings are in millions. Like that. So what we are charging P&L, and get this clearly, we only charge P&L the finance costs. You cannot bring finance costs and interest in the same table. Interest into our finance cost, it is part of that. And that's why when we pay interest, we reduce the finance cost. So you only bring, I've seen some students bringing finance cost and interest at the same time. Fine, it will not add any value or subtract any value because they will mark the finance cost. But ideally, I'm assuming now you're going practical. When you have finance cost and interest, and I've really explained why finance cost and interest. Finance cost is the market capitalization. It takes into account the interest, inflation, and all those others. So finance cost is a combination of all. And that is when we pay, when we pay interest, we reduce the finance cost. But now you see in accounting, we normally work on accruals. Accruals means whether paid or not. So you bring the entire finance cost, which includes interest and other items. So you come here and say, expenses is just an extract. So we have here finance. So finance charge. We can call it finance charge, which is 40 for this year, and this is 43.2. Correct. Thank you. Let's go to the next one. Extract from the statement of financial position 2018-2019. So I want to delete this one here. So remember, we're in the book of the issuer. So statement of financial position, extracts. So statement of financial position, extracts, 2018, 2019. 2018, 2019. So non-current liabilities. Non-current liabilities. We had 12% bond. It was a bond. So balance sheet, you pick the values at the end. Balance sheet is prepared as at the end of the year. So this one here and this one there. Those two. So 216, 235. And you fully answered that question. Let us do only one more question. I know we have some people here who need to cook. Na kesho pia ni kazi, so that I should not inconvenience them that much. Wakati kafika mtazoea. The first time, msiwafinye sana. So let's do one more question. Let's do one more question. Then I can release you. November 2020. November 2020, question 5B. Unless someone has a question here. November 2020, question 5B. B for boy. Please, once you get it, just give us the page. Page 71. So let's meet in page 71 for November 2020, question 5B, page number 71. Let's meet there. And I read, it says, on 1st January 2019, Dodoma Limited issued 1 million bond instrument with a face value of shillings 100. Okay, at a market price of shillings 95. So they gave them at a discount. Bond brokers charged the fees totaling to 1.8 million in relation to the bond issue. The bond carries a coupon interest rate of 5% and are redeemable in 3 years at a face value. So face value of the bond is the one, it is 100 million. The 100 times the 1 million. So face value, where we pay at a discount, that is your own problem. But redemption will be redeemed at face value, which is 100 million. The 1 million times shillings 100. Though the cash they will be receiving at 95 shillings, but redemption will be at 100 million. Okay. Dodoma Limited wishes to account for the bonds using the amortized cost method as per IFRS number 9, financial instruments. Of course, they had to be. Which one is that? They had to issue them, they had to account for them using amortized because already they have said 3 years. However, there is some confusion about how the bonds should be accounted for. The cash received from the bonds issue of 95 million has been recognized as an uncurrent liability. The broker's fees of shillings 1.8 million were deducted from the carrying amount of the non-current liability. The coupon payment of 5 million has been expensed in arriving at the profits before tax. The effective rate of interest is 7.62%. The coupon interest payments are made at the end of each year. Required, demonstrates how the bond issue should be accounted for in the books of Dodoma for the year ended 31st December 2019. Those are 10 clean marks. So there you have to be very careful. You have to be very careful. Kupata 10 marks, you have to be very keen. So when they say discuss, demonstrate, illustrate in financial reporting, it means it will be hybrid, combination of write-up and the calculation itself. See, to answer to calculation straight, partner. In financial reporting, any moment you hear discuss, illustrate, and there are some figures, it means your answer should be combination of both narration and computation. And the narration, you don't just narrate whatever you feel like you should narrate. The narration should always be based on the requirement of that standard. What does the standard say? Standard nataka nini kuhusu. So you need to tell us according to IFRS 9. So from there you can bring anything in the picture. According to IFRS 9, finance cost, interest, you just say anything. Then based on that, you can give us now the computation. Then you close it. It is 3 tiers. Tier 1 is the explanation on what the standard requires. And by extension, you can even say what they did which you feel is wrong after you have said what the standard requires. So you give us the requirement of the standard. You can say maybe something wrong which they did, or if they did it right, also you can mention. Then you do the computation. Then you finish by telling us how it's supposed to be accounted for in the books, because you know you are now the accountant. Now that is your responsibility. Your responsibility is not narration, it's not calculation, but it's presentation. But now, because all are vested on you, you have to talk of the narration, the computation, and the presentation, those three. So let's answer it this way. So the narration will differ for students. Mtu ataongea tu kwenye nasikia, but at least you try to be within the standard requirement. But for standardization, let's just write mine to make the work easier. So you say under IFRS 9, under IFRS, International Financial Reporting Standard, IFRS 9, IFRS, anaandika hivi, andika, under the IFRS 9s, yeah, that F is what I wanted with the apostrophe. According, under IFRS 9's amortized cost model, under IFRS 9's amortized cost model, a financial liability should initially be recognized at their fair value. Initially be recognized at their fair value. Recognized at their fair value of the cash received. Of the cash received. Full stop. Full stop. So something we have seen in this question, kulikuwa na brokers. Hii pesa ya brokers. So how will we go about it? So we need to talk about it. You say any direct cost attributable to the bond issue. Any direct cost attributable to the bond issue. Attributable to the bond issue should be offset. Should be offset against the carrying amount. Against the carrying amount of the liability. Against the carrying amount of the liability. Full stop. Full stop. Another hyphen. Therefore, on initial recognition, the bond should be measured as follows. Should be measured as follows. Then sasa tufanye hesabu. When you come here and say shilling, you say consideration of the cash received. Consideration of the cash received. I remember they received 95 million because they had issued the bond at a discount. Then, of the 95, unajua wapeana bond, watu wakalipa 95. Then kulikuwa na brokers. Brokers charge them 1.8. You know brokers, you have to pay them one-off malizane ndio mwende amortization. So the value of the bond which is going to be subject to amortization should be less any cost you have incurred exclusively to issue this bond. So you less issue cost. Brokers. The brokers fees. Brokers are charged as 1.8 million. Therefore, the bond value, which now the investor will be interested to angalia. Investor juu mambo yako na brokers, hata utaki ajue, atakasirika, okay. So kuna watu walikula, so that is none of their business. So Bond value will be 90, which one? 93.2? Yes, it should be somewhere there. 93.2 million. 92.3 million. So which concept am I bringing in this question? The concept I'm bringing in this question is that when the issuer incurs direct costs to issue a bond, then such direct costs should not be subjected to amortization from the amount which has been received. So you deduct. However, you know, as we move ahead, we get different questions. If the cost has been incurred by the investor, ule mwenye anapeana pesa, yeye ameincur those costs, then that cost is added, inaongezwa. It will be amortized. So it depends with who is incurring the cost. Maybe you can write it as unstructured somewhere in your book. If the cost is incurred by the issuer, you subtract. If the cost is incurred by the investor, you add it back, because that is an extra cost to them, which they need to recover. Why should I pretend I'm investing and it may recover? Maybe it can even be more. So you have to be very careful. So if you are dealing with the books of the investor, a time is going to come where we're going to deal with the investor. You have to add. You add it back. But borrower, you subtract the other investors in June. So this is the value of the liability. Value of the liability. So down there, you say, you write down there, I want to see what they did. How did they account for the 95? They recognized the entire 95 as a liability after deducting hiyo walisema. So, but now the only problem they did not amortize. But initially, they recognized, the examiner said somewhere that the cash received of 95 has been recognized as a non-current liability. The broker's fee of 1.8 was deducted. So that one, they did a good job. And we have to mention that. So let's mention that down there. You say, the initial recognition and measurement. The initial recognition and measurement. The initial recognition and measurement of the liability. The initial recognition and measurement of the liability has been accounted for correctly. Has been accounted for correctly in the books of Dodoma Limited. Has been accounted for correctly in the books of Dodoma Limited. Full stop. Full stop. A different paragraph down there. However, IFRS 9 requires that the bond should be amortized. Requires that the bond should be amortized. Should be amortized over the bond period. Over the bond period. Using the effective interest market rates. Using the effective market interest rates. Using the effective market interest rate as follows. As follows. So you have to amortize. You have to amortize as follows. So have the bond amortization. So bond amortization. We have to amortize that bond over over those 3 years period, 2019 to 2021. So here, balance brought down, finance cost, which was the effective interest rate is the effective rate of interest is 7.62%. So 7.62%. Then the actual interest is 5%. So interest is 5%. Then you will get the amortized cost at the end, which is the balance carried down here. Correct. All right, so we keep going. And this is how we start. Interest, so sorry, this is 2019, 2020, 2021. So interest is always constant, and interest is always based on the nominal value of the bond. Nominal value of the bond was 100 million. Year 95, you saw, the discount. So interest is always based on the nominal, which is 5. They are even mentioned somewhere there. 5% of the 100 million, which is the 5,000. So the 5 million, sorry. So we'll be subtracting here 5 across. We'll be subtracting 5 there. Mohammed, someone kindly screenshot for the notes you wrote. Mohammed, notes ni kidogo sana wenye wameandika. Your page 1 and page 2. Page 1 and page 2. I've shared the notes in the group, which even them they have not written. We discussed. They are going to write later. So maybe someone will share for you where we started the question. In page 2, you will see the question. There's a question in page 2, illustration in page 2. So you will ask for the solution to that question. That is where you should start the write-up. Not start the write-up, you need to write all of them as per the one which I've shared, then you connect from there. All right. Finance cost will be based on the amortized cost. So balance brought down. We don't amortize the 100 million. They issued at 95. Then Ukakuwa brokers. That one we have subtracted. So the value will be 93. 93,200. That is what we subject to amortization. Discount or diskidana, no problem. You know, the interest will help you to pay faster. So discount, that is a local arrangement. But the actual value after all those things is 93,200. The investor, this is what we now amortize. So 7.62% of this. Can you give me those figures, please? Help me with the figures. Chapa hiyo then tupumzike. Wenye wako na haraka. Give me the figures, chap. That is 67, 66. I think, see, when I equal 7, there's 7.62, 20 zeros. Gideon Ebu compute 7.62 of 93. That was 6.7 or let's see answer from maybe someone different as well. If the same, you are different with the Perez, 7. Perez gets the same with Mohammed. So Gideon kindly confirm 7101. 7101 840. So balance carried down will be this plus this minus the actual interest. Make them as well they want to repeat, they will just bring the same. Mtangalia la sitting kama tulikuwa na financial instruments. What do you get? And by the way, because I can forget when we finish the class. Which early mornings are you always free? I can always teach you. Because me, I'm free all the early mornings, except Thursday and Friday, which I teaches you. So not gonna sing. Which early mornings are you? Everyone is free. I'm not class. I can always try to come in. If you answer that, give me the current down. That will be 100 minus 5, 93 again, or 95. It will be 95, 301, 95, 301, 840. All right. 95, 301, 840 by 7.62%. 'That one by 7.62%, 72, 62 thousands. 72, 62 thousands. Carry down, we are almost there. This plus that minus the interest. Carry down will be how much? That is 102 minus that, around 98, 97 there. How much is the amortized at the end? $97, 563, 840. 7.62% of that. $7.62 of 97. What do you get? Seven, 4, 3. 7, 4, 3. 4, 3, 6, 5. Then the last year should be 5 million, 5 million plus 100 million. They will redeem the principal. This one here. The redemption, they redeem the principal plus the interest. So it is 97 plus 7. I don't know that this one will be 105. This one seems like 104 or something. I don't know how. What are you getting? You are getting negative something. Negative what? But which is nil. The amount has fully been paid. But just tell me comes to how much they are claimed. You cannot have a balance there. You are getting a negative of I'm waiting. 1795, yeah. Hiyo ni kidogo sana. Rounding off, so they have just paid. They have just paid everything. So check how we did our question. We started by saying what the standard requires. Then we went to the main thing in this question was the issue cost. So we said what standard requires, the issue cost, how we're supposed to deal with it. Then we dealt with that issue cost. Then we explained again about the amortization. We have amortized. Now you need to tell us how to recognize. So now you tell us here, Dodoma Limited should recognize finance costs. Finance costs and a non-current liability, for each of the 3 years. For each of the 3 years. So in the P&L, they need to recognize this one here. Then in the balance sheet, they need to recognize those amounts there. So wao walifanya kidogo tu wakaachilia. So when I meet you on in our next class, we need to talk here. December 2021. December 2021, question 3B. You can check on that question before our next class. So I want to hear from everyone. How is always your Mondays? Kama kuna mtu mmoja kuna class that is cancelled. How is always your Mondays? Is there someone who has a class on Monday? Once someone says yes, then that is impossible. So Yvonne has a class on Monday. How about Tuesday? How about Tuesday? Anyone with a class on Tuesday? Anyone with a class on Tuesday? Anyone with a class on Tuesday? Who's Safaricom ni nani? Safaricom, who are you? Kuna huyu Safaricom Neon Ray Ultra. Who is that? So I see Tuesday is a class. How about Wednesday? How about Wednesday? Yes, there's a class. So Thursday, Friday, we have a class. How about Saturday? Saturday, do you have a class? No. Silau has a class on Saturday. So hiyo imepambana. Sawa, nitakuwa na wafu. Haya. Sunday, I know there is no class. So options, which we need to agree. Do we meet on Saturday, a time like this, maybe 6 to 8:30, then Sunday, leo ni venye stima iko huku kwetu, but we can still meet at 6 to around 9 a.m. in the morning, then again in the, evening, or we rule out Saturday, then Sunday we meet twice, in the morning, and also in the evening. Makasi, the problem, some of us Saturday they are working. I'm very sure there are people who work on Saturday. Itakuwa shida kubwa sana. So last Sunday you have 4 classes. So with time, I think Sunday will be going for 2, very early and very late, like today, ndio tumalize. So let's meet in our next class. Thank you for coming. You can be checking this question before we meet in our next class. Otherwise, thank you. Have a good night and a nice week ahead. Thank you.